Hello and welcome to another episode. In today's episode, we will look at the protective put options trading strategy, and we're going to look at what the protective put option trading strategy is, what you can do to deploy such an option trading strategy, and when you should be looking at this strategy as the one to deploy. We will also look at what could go wrong with this strategy and what could go right. And we will use Optionstrat, as you're seeing on the screen right now, to visualize a sample protective puts options trading strategy, and we will analyze the risk reward ratio. If this is your first time, please do us a favor, hit that subscribe button so that you don't miss new videos. And while you're at it, you want to also hit the notification bell so that you get to be notified of videos as soon as they're uploaded. And if you haven't signed up for your Optionstrat account, please use the link in the description below to sign up for your account today. It's a fantastic tool to help you to visualize different option trading strategies. All right, today it's protective put strategy. Let's get it. Before we continue, I'd like to make you aware and invite you to register for a free online self-paced financial literacy program that is coming soon to a screen near you. Did I say it was free? Yes, you heard that right. You will be taught about how to make the most of your money and get it to work for you so that you can get to that point in your life where you can have enough investments that are generating enough income to take care of your necessary expenses. Why is this important? Imagine being able to live life on your terms and not having to worry about how to pay for your living expenses. Follow the link in the description below and register. Like I said, it's free, and you will be able to take these lessons at your own pace. Each lesson should be no more than 30 minutes of your time. This is a freebie you cannot afford to miss, and you will not regret signing up for. So what is a protective put? The protective put is also known as the married put options trading strategy, and it requires you to already own 100 units or multiples thereafter of the underlying asset. And in entering a protective put, all you have to do is buy a put option at a strike price. For buying this option, you pay a premium, and paying this premium grants you the right, but not the obligation, to sell the assets that you've owned previously at the said strike price on or before the expiration of the put contract. Why would you enter into a protective put contract? You do so probably because you are anticipating a drop in the price of the underlying asset. And buying a protective put is like buying an insurance to ensure that you can sell the asset that you own at your desired strike price on or before the expiration of the contract. So it's a protection against the potential downside, but that also allows you to be able to reap some benefits from an upside if that upside happens with the price of the asset that you own. Right, let's go to Optionstrat, and we click on the build drop down and we select the protective put option, and we're going to use the example of ticker symbol ORC to describe the protective put options trading strategy. So if we look at Yahoo Finance, at the moment, ticker symbol ORC on the 4th of January 2023 is trading for $10.68. And when we check out the charts, you will realize that ticker symbol ORC pays a monthly dividend of about 16 cents per share, which is a good payout. As we see here, this is a payout in excess of 18%. That's not a bad asset to own over time. So let's assume you have bought ticker symbol ORC on the 4th of January 2023, and you're happy to sell your shares at $14 on the 21st of July 2023. So what will happen is you come to Optionstrat, select the protective put strategy, you enter ticker symbol ORC, and then you select the July 21st expiration date. And then what you do is you drag the put indicator to your desired strike price. In this case, this is the 14 put. And what you realize here, it shows you the profit and loss range. And even though it says profitability starts from $16, we will run an analysis now to show you how you can make money either way, whether the stock price goes up or goes down. So let's look at the analysis of what could happen with ticker symbol ORC. So at the moment, the price on the 4th of January 2023 is $10.68. So you buy 100 units at that price, and then immediately you also buy the July 21, 2023 $14 put, which will cost you $4.20. So your total put cost is $420, which means that if you combine the cost of buying the put and the cost of buying the shares, your total investment is $1,488 on a 100 unit purchase of the underlying asset and the put contract. Now remember, we've said that ORC pays a dividend of 16 cents per month. So your expected dividend for the next 6 months would be about $96. Now let's look at what could happen. Let's assume that by the 21st of July 2023, the price of ticker symbol ORC is above $14. Let's say $15 for argument's sake. Remember, this is all illustrative purposes, so don't use this as a basis for making any financial judgment. You need to run your own analysis. But say the price of ticker symbol ORC is above $14 and is at $15, then your protective puts that you have bought will expire worthless. But it also means that you can sell your shares for $1,500, which is the $15 multiplied by the 100 units of shares that you have. And this means that your total receipts, when you calculate the $1,500 and the $96 dividend that you would have received monthly, will translate to $1,596. This represents a $108 margin over your investment of $1,488. That includes the cost of buying ticker symbol ORC at 1068 and also buying the put at 420. This will mean that within that 6 month period, even though you incurred the cost of the put, you could still come out with a net margin of 7.26%. What's the flip side? Assuming ticker symbol ORC is down to about $5 by the 21st of July, potentially there is an intrinsic value of the put that would be about $5, which means you can sell the put contract before it expires and receive receipts of $500, which is $5 times 100 units. Now, because you sold the put contract, you will still keep your shares of ORC, so you still own the shares, you haven't sold them. And that means that the $500 and the $96 you received in dividend would translate total receipts of $596. This will mean that you have a yield or income generated from owning the shares of about 40.05% within that period when you compare the $596 to the $1,488 investment that you've made. So this is an illustration of how you could benefit depending on if the price of the ticker symbol goes up or down with specific values. In summary, we have seen that you can enter a protective put when you buy a put contract on shares you already own with the objective of reducing the risk of losses on the downside and potentially generating some yield from yourself while you still own the shares, and also the potential of making some money from the upside by being able to cash out from the sale of the shares. I hope this makes sense. In our next episode, we will talk about the bull put spread options trading strategy, and we will visualize this on Optionstrat as well. Thanks for dropping by. Of course, if you haven't done so already, please do not hesitate to hit that subscribe button and also hit the notification bell so you are the first to see new content as soon as they're uploaded to the channel. If you know anyone who will find this video informative, please do us a favor and do them a favor by sharing the link to this video with them. And if you have any questions about something you've heard or you would like a particular topic to be discussed, please leave a comment in the comment section and we'll be sure to respond. Lastly, another reminder for you to sign up for that free financial literacy training that you will see the link in the description below. Of course, you want to check us out on Twitter, Instagram, and TikTok using the links shown here, and we'll also leave the links in the description. Thanks for dropping by and see you on the next episode.